Going into business for yourself is both a rewarding experience and a path to building wealth. Today, I'm going to tell you about the different ways a small business can be structured to help you make the right choice. Hello and welcome to Practical Personal Finance, where you get the information you need to understand and succeed with money. Today, I'll be talking about three popular business types: the sole proprietorship, the limited liability company, and the S corporation. And this video will be broken into three parts. In part one, I'll compare the sole proprietorship and the LLC from a legal perspective. In part two, I'll again compare the sole proprietorship and the LLC, but from a tax perspective. Finally, in part three, I'll get into what an S Corp is and how it could benefit your business to the tune of thousands of dollars. Alright, so let's get started by taking a look at this from a legal perspective. How does a sole proprietorship compare to an LLC? Well, in the eyes of the law, your business can either be its own separate entity, like in the case of an LLC, or it can just be an extension of yourself, like in the case of a sole proprietorship. When it comes to the actual day-to-day operations of your business, there's not much of a difference. Let's use the landscaping business as an example. Whether you're a sole proprietor or an LLC, you're still going to be spending most of your days mowing grass, trimming hedges, and pruning trees. The differences have to do with paperwork, fees, and most importantly, separation of assets. In order to go into business as a sole proprietor, all you need to do is start working. There's no forms to fill out or fees to pay. It's the default option when you start a business. On the other hand, if you wanted to go into business as an LLC, you would need to fill out some paperwork with some basic info about your business, file that paperwork with your state, and pay an annual registration fee to keep your business active. You may be wondering, why would I go through the trouble of filing extra paperwork and paying an annual registration fee when I could go into business as a sole proprietor? Well, that's where the whole separation of assets thing comes into play. If you were in business as a sole proprietor and your business was sued, your personal assets like your home, your car, and your personal bank account are all fair game because the business is simply an extension of yourself. On the other hand, if you were in business as an LLC and your business was sued, your personal assets are not at risk because your business is a separate entity. In the case of the landscaping business, they might be able to come after your mower, your hedge trimmer, and your business bank account, but everything you personally own is safe. That's why it's called a limited liability company, because your liability in a lawsuit is limited to the assets of the company and nothing more. Before I move on, if you're getting some value out of this video so far, do me a favor and click that like button down below. Doing so helps other people just like you find this content, and it helps my channel grow as well. Thanks. Okay, next, let's take a look at all of this from a tax perspective. How does a sole proprietorship compare to an LLC? In the eyes of the IRS, there is no difference between a sole proprietorship and an LLC. That's right, by default, these two types of businesses are taxed in exactly the same way. Both are considered by the IRS to be something called a pass-through entity. What that means is that all the profits generated by your business pass through the business and are simply counted as your own personal income. Being a pass-through entity is awesome because you avoid something called double taxation. Double taxation is when a business has to pay corporate tax on its profits, and then the owners or shareholders still have to pay personal income tax on what's left over. As the owner of a small business that's considered a pass-through entity, you don't need to worry about corporate tax. The profits from your business are only subject to personal income tax. That being said, there is a special tax you will need to pay called self-employment tax. The self-employment tax rate is 15.3%, and it goes to pay for both Medicare and Social Security benefits. You may be familiar with the concept of 7.65% of your normal paycheck going to pay for these social programs. And if so, you might be wondering, why would I need to pay twice as much now as a small business owner? Well, you may not realize, but your employer is responsible for matching that 7.65% that comes out of your paycheck, for a total of 15.3%. Now that you're both the employer and the employee, you get to pay both in the form of self-employment tax. Last but not least, let's talk about what an S Corp is and how this special business classification could save you thousands of dollars per year. The first thing you need to know about the S Corp classification is that it's not a legal classification like an LLC. From a legal perspective, your small business will either be a sole proprietorship or an LLC like I discussed earlier. But if your business is legally an LLC, you can decide to be classified as an S Corp from a tax perspective. Doing so involves more fees and paperwork, but there are some special tax advantages that might make it worth the effort. If you decide to classify your small business as an S Corp, you'll need to hire yourself as a W-2 employee and pay yourself a reasonable salary. That means running payroll and paying payroll taxes every few weeks and filing payroll reports with the government every quarter. You can do this yourself, or you can hire a payroll company to do it for you. You will also need to file a different, more complex tax return for your business every year called an 1120-S. You can still do it yourself, but you may want to pay a CPA to do it for you to ensure it's done properly. If you're willing to go through all of that trouble though, there may be a nice reward. Despite its name suggesting otherwise, being taxed as an S corporation does not involve the double taxation or corporate taxes I mentioned earlier. Your small business will still be a pass-through entity, but with an added benefit. Once you've paid yourself that reasonable salary, any additional profits will not be subject to the 15.3% self-employment tax. So if your business earned an extra $40,000 above and beyond your salary, you've just added an extra $6,120 to your wallet, just by doing some extra paperwork and paying a few minor business expenses. Not a bad deal. To wrap things up, here's how I would suggest you structure your small business. If you're just starting out, you want to test the waters, and there's not much risk of getting sued, go with the sole proprietorship. It's easy and there's no commitment. If you know you're serious about this business thing, you've got a substantial amount of assets to protect, or there is some risk of a lawsuit, then go with the LLC. It's really not that difficult or expensive. If you've been in business for a year or two and you're seeing consistent profits above and beyond what a reasonable salary would be, elect to be taxed as an S Corp and save yourself thousands of dollars in self-employment tax. Simple as that. If you're interested in making the transition to an S Corp, I recommend choosing Gusto as your payroll provider. The base cost is just $39 per month plus $6 per employee on the payroll. I've been using their service for more than 5 years and I've never had a single complaint. As an added bonus, if you use the referral link in the description and sign up, you and I will both get a $100 Visa gift card when you run your first payroll. Do you have a small business? What type of work do you do? Let me know in the comments. If you enjoyed this video, I made another one about how to file your tax returns as a small business owner. Click right here to watch. And if you're not already a PPF subscriber, click right here to hop on board. As always, thanks for watching. I'm Andrew Scheer, and I'll see you next time.